Welcome back friends to the class number 34. So in this video we will discuss why do bank decline your loan application when they see liquidity crunch in your financials. So this is the question comes in the mind of everybody that I am in dire need of funds and bank is not ready to support me. So why do they decline your loan request when you are actually in need of money? So let us understand in this video. I will be talking in the context of working capital loans only. I am not covering any other aspects which might be there. I am talking about only working capital loans. So question is why banks don't fund you in liquidity crunch time, right? So let us understand what is liquidity crunch in my video terms, in my videos terms. So suppose there are current assets and there are current liabilities in your business. The current assets are rupees 25 and the current liabilities are rupees 20. So that means in the next 12 months, you are planning to recover 25 rupees from your assets and planning to pay off 20 rupees on your liabilities. That means rupees 5 is still you are getting extra within next 12 months. So if this is the situation, then bank is ready to give more working capital finance to you, which is strange because your liabilities are sufficiently already managed, right? So let us understand the second scenario now. Here the current assets are rupees 20 and the current liabilities are rupees 25. That means in next 12 months you are planning to recover 20 rupees and you have to pay 25 rupees in next 12 months. That means you are short by 5 rupees. You don't have 5 rupees to pay in next 12 months. That means you need that money to pay off that 25 rupees in next 12 months. So that means technically speaking, this situation represents that you need money for your business to repay your liabilities. So if this is the situation, then everyone will say that I will need bank loan in this situation only, and the bank should give me loan to support me to recover from this situation, right? But if this situation comes in your business, then bank do not give you any more working capital finance, which is a strange thing, but a very conceptual and logical things done by the banks. It's just a matter of thought process how you think about this situation. I have shown you only one side of the coin by saying that you are recovering 20, paying 25, that means you are short on 5 rupees. I have shown you only one side of the coin, but there is another angle to study this concept which is more logical and more conceptual, which will help you in understanding why bank decline when this situation comes in a working capital finance. So bank don't agree to provide more working capital finance in this situation, but why? But why? This is what we trying to learn in this video. So before starting the concept, I want you to recall what we have learned in class number 27. If you have not watched the class number 27, then please watch it. Then only you can have clear idea of what I am discussing in this video. So suppose this is the profit and loss account of the client. I have deleted all the gross profit related points. So I have merged the trading, manufacturing and profit and loss account in a single T format table right here. So these are the sales, this is the closing stock, and this is opening stock, purchase, direct expenses, indirect expenses, and this is your net profit. Naturally, in this simple profit and loss account, whatever profit you have got, you must have got the profit from your sales. Your sales are added, your sales are always including profits. So these net profits are always derived from the sales value. The closing stock is never valued at cost plus profit area, cost plus profit method, right? So whatever the total of profit and loss account is of both the sides, these all of these things are merged in these two only. If you see carefully, the total of all these things is merged into only two of these things, right? The sales and the closing stock. The closing stock figure comes exactly the same in the balance sheet asset side. The same closing stock gets appeared in balance sheet asset side. So this amount comes in this side of the balance sheet, which represents your investment in stock. The sales you have done to your customer, so you need to recover the amount from them. If you have not recovered the amount from them, then these are called debtors. So whatever sales amount that you have not recovered from them, reflects as debtors in the balance sheet, right? So these debtors represents the unrealized amount on your sales, right? So if we come on the expenses side, then we will see that whatever expenses that you have not paid, reflects under the head creditors. These can be creditors for goods, for purchases, right? And creditors for expenses, for direct or indirect expenses. So whatever expenses that you haven't paid yet will reflect as creditors in the balance sheet. So the summary of your whole profit and loss account gets reflected in the balance sheet in these three assets, these three items: debtors, stock, and creditors. Of course, there are other current assets and current liabilities as well. And if you study carefully, the more or less they are related to the profit and loss account only. Like wages payable may be shown separately, GST payable, GST recoverable. These are all related to sales and purchase, or related to expenses and other incomes. So right, so these all other current assets and current liabilities that appears in the balance sheet, more or less they relates to the profit and loss part only. So right, so for the simplicity sake, I have taken the example of only three items to make you understand the concept more clearly. So the creditors represents the expenses that you haven't paid yet. Debtors represents the sales that you haven't recovered yet. The stock represents the investments that you have done, which is not yet realized by doing sales and recovering from the parties, right? So these three things in combination, what do they represent? If we combine stock and debtors, then what does it represent? It represents the expenses of the business, of course including some profits, because sales includes profit and debtors comes from sales only, so the debtors amount includes some profit element as well. So the expenses of the business which are incurred, you have incurred expenses on doing sales, on making the product which you have sold. You have incurred expenses in making the product which is unsold. You have incurred the expenses, but you have not recovered that expenses. You have not made any realization from that expenses, because the sales amount is not paid off by the debtors yet, by the customers yet. The stock is not sold yet. You have done your investments in making those products which are sold to them and which are in your company, but you have not realized any cash from them as of yet. So these represents your investments, right? So now the question is, the products that you have sold, the products which are in your factory, you have incurred expenses to make that product, right? Now the question is whether you have made payment for those expenses or not. Whether you have made payments for those expenses or not means whether there are any creditors in your balance sheet or not, right? So it means if you have not done payments for your expenses, if you have not done payments for your expenses, that means your investments is adequately supported by them. Your investment amount is supported by them. You haven't realized anything, you haven't paid anything to them. You haven't realized anything, you haven't paid anything, right? Keep these words in your mind. You haven't realized anything and you haven't paid anything as well, right? So you are properly supported by the creditors, right? So you have not done payments to the creditors. So if your unrealized investments in stock and debtors are rupees 20, and your creditors, the support that you have got, the support that they have given to you are rupees 25. You have incurred rupees 20 which are not realized yet, but you have taken support of 25 rupees from them. You have taken 25 rupees worth of support from them. That means you have already taken 5 rupees of extra support from them. You have already taken 5 rupees worth of extra support from them. Then why do you need more support from the bank for in terms of loan, right? Earlier we have read this thing in a different way. Earlier we were saying that we are about to recover 20, we have to pay 25, that means we are short by 5 rupees. But no, this is not the correct way to read it. We will read it as 20 rupees were unrealized, 25 rupees support we have already taken for these 20 rupees investment, then what is the need for another support from the bank? That means we are diverting our money somewhere. We have taken 25 rupees support. These 5 rupees, that extra support we have taken, we must have invested in some other assets, right? So why do we need extra supports then from the banker if we are not managing that properly? So that is why in this situation bank does not provide you more support. Bank says do it that you have already taken maximum support, more than the required support from your creditors, then I will not give you any further support in this situation. So means already excess support is taken by the entity, then there is no reason to provide them more support again. So now the second situation, which is more important, payment done. You have done some payments. You have invested 25 rupees. You have got the support of 20 rupees only. So that means 5 rupees investments you have done in cash. Your 25 rupees expenses are not recovered yet from your customers or your stock. 20 rupees expenses are supported by your creditors. They have told you that you need not to pay to us at this point of time. You may pay us after 2 months, 3 months. So that means 5 rupees worth of investments you have done out of your pocket or some other sources of funds. So 5 rupees payment is actually incurred by you in these 25 rupees investments, right? But where these 5 rupees have come from? Where these 5 rupees have come from? It is the amount incurred after adjusting the support that I have already told you. But the question is where these 5 rupees have come from to invest in these 25 rupees. Option number 1. These 5 rupees were introduced by you from your own capital, from your own pocket, from your own sources. So your money gets stuck up in this. Technically, your money, which was to be used for long-term purpose, since it is your money, it is your capital. We have studied in the previous video that long-term funds, long-term sources can be used for short-term investments and long-term investments as well. But you have used your long-term funds in short-term investments. In short-term investments, that means your money gets stuck up in this, which could have been used in buying machinery, in buying building, in expanding the business. In other words, you could have used that 5 rupees money for long-term purpose for expanding the business, but you have invested that money in your stock and debtors. That means your money is stuck up in the short-term investments. So how will bank read this? Thus bank will try to fund to you for your growth. Bank will say, let me give you that 5 rupees. Let me give you 5 rupees or 3 rupees, whatever the bank decides. Let me give you something out of these 5 rupees. Let me free up your 5 rupees, partial 5 rupees, partial amount out of these 5 rupees or full rupees 5. So you use these 5 rupees in your long-term business investment. We will take care about your short-term investment needs. So in this situation, bank will try to fund to you working capital finance. Thus, bank will try to fund to you for your growth, working capital cycle management, and release of your own funds, rupees 5, so that you can utilize them for more productive purpose. Now comes the second situations. That 5 rupees that you have paid, you have arranged that payment from outsiders like banks. You have taken some other loans from banks and used that loan amount, 5 rupees loan amount, for investment in this, right? So if you have raised loan from third party, that means you have taken support from other than creditors who are also third parties, right? So if you have already taken support from a third party, then why would bank support you again? It is the same situation as like this, where you have taken adequate support from third parties, then bank is also a third party, then bank will not provide any more finance to you, right? So that was the concept that I wanted to discuss with you. I hope you have understood it in totality. If you have any confusion, then please don't shy to make a comment about this. I will try to report in best possible way. See you in the next video. Till then, thank you very much.